Hello everyone and welcome back to Markets Analyzers. The stock market has been unpredictable lately. Some days we see a rally and the next day a sell-off wipes out all the gains. From recent peak, Nifty has corrected by approximately 15%. Small caps have fallen by around 25%. And a rare event has also taken place. Our markets have fallen for 5 months continuously, which happened around 25 years back. So I hope you understood the depth of our recent market correction. Obviously, investors are confused. Should they buy the dip, hold their positions, or cash out before things get worse? To get clarity on what's happening, let's analyze the recently released Q3 earnings results, which hold crucial clues about the market's direction. Some companies have posted impressive numbers while others are just struggling. So the question is, are we witnessing the start of a strong recovery? Or is this just a temporary bounce before another downturn? By the end of this video, you will know which sectors are driving the growth and which ones are struggling. What is Warren Buffett's latest strategy that tells us about the market? And finally, we'll learn whether it's the right time to invest or wait for better opportunities. So, without wasting any time, let's break it down. Quarterly earnings reports give investors a snapshot of how well companies are performing. They reveal whether businesses are growing, struggling, or stagnating. In Q3 FY24, October to December quarter, Indian companies showed a mixed performance, with some sectors thriving while others faced challenges. The key question, are we in a genuine recovery or is this just a temporary bounce before another correction start to begin? Let's look at earnings growth over the past 5 quarters to get some idea. So in Q1 FY24, the earnings have grown at 20.7%. So it's a very good growth. Similarly, in Q2 FY24, it grown at 18.9. In Q3, it grown at 14.2. In Q4, it grown at 9.5. Whereas in Q1 FY25, it fell down to 8.1%. In Q2, it formed a low of 6%. In recent quarter Q3 FY25, the earnings growth have been at 10%. So if you look at this data, we can observe that earnings rebounded sharply in Q3 FY24 after weaker Q1 and Q2. Corporate profits have improved significantly. But is this sustainable? The big question is. To get the answer for our question, a genuine recovery or just a short-term boost, let us try to observe what is behind this growth, what is driving this growth. The main sector which is driving the growth is banking and financial sector. So let's try to know why banks are outperforming. Higher interest rates, the main reasons why banks are outperforming is higher interest rates. So high interest rates means higher profits. Banks benefit when lending rates rise. Along with that, strong loan growth and improved asset quality. So these are all helping banking and financial sectors. HDFC and ICICI Bank reported double-digit profit growth due to higher NIMs, net interest margins. The other sector which is performing well is infrastructure and manufacturing, which is showing steady expansion. So the reasons why this sector is growing is due to government capex boost along with industrial production growth. L&T, Larsen & Toubro saw a strong order book of around 75,000 crore rupees and a steady revenue growth. So L&T is a major player in this infra space. So if you observe their order book, it will indicate the strength of our infrastructure and manufacturing sector. So it's looking good. Okay, until now we have seen the key growth drivers, but what is holding the markets back? Which sectors are not performing up to the mark? So IT sector is a major sector which is struggling right now. The IT stocks are under pressure due to weak global demand. US and European clients are delaying projects. Infosys and TCS reported lower than expected revenue growth due to reduced client spending. Along with IT sector, FMCG is also showing weakness. Rural demand slowdown has played a key role in FMCG space. High inflation has hurt rural purchasing power. Companies like Hindustan Unilever posted flat volume growth. To sum it up, until now, we have seen earnings growth of 10% in Q3 FY25. So it is recovering. But the key sectors which contributed was banking and infra space. But other key sectors like IT and FMCG are still struggling. They are lacking behind. If you then look at investor sentiment at this moment, even though the earnings growth has rebounded in recent quarter, but the market is not in full bull mode yet. The key concerns why markets are not moving up is due to uncertainty over US and global economy. The US and global economy face uncertainty due to two key factors: Federal Reserve rate cut decisions and Trump's tariff threats. If the Fed keeps interest rates high to fight inflation, borrowing cost will remain elevated, potentially slowing economic growth. Meanwhile, Trump's proposed tariffs could raise import cost, feeding inflation and disrupting global trade. Together, these factors create volatility impacting businesses, consumers, and financial markets. The next big concern is FIIs, foreign institutional investors. In the last 5 months, FIIs have sold 2.2 lakh crore worth in Indian markets, driven by global uncertainties, high US interest rates, and risk aversion from Indian markets, majorly from emerging markets. This has led to rupee weakness and increased market volatility. However, FIIs could return to India if the following happens. Fed rate cuts make emerging markets more attractive, or stable global conditions which reduces risk, and definitely this should happen. Strong corporate earnings in India which will boost investor confidence. So either of these three should happen. So how are different investors reacting to this market fall? Retail investors, people like us, are cautiously buying the dips, focusing on strong sectors like banking and infrastructure, while avoiding overvalued FMCG and IT stocks. FIs, on the other hand, remain hesitant due to high interest rates, India's premium valuations compared to other emerging markets, and global recession fears. So FIs are on the backseat right now. DIIs have been the market's backbone, we should say, with over 16,000 crore in SIP inflows into equity mutual funds in January 2024 alone, helping stabilizing the markets by observing FIs outflow. FIs are nothing but retailers buying through mutual funds. We have seen how different investors are reacting to this fall. But let's take a moment and look at how the greatest of them all, Warren Buffett, is thinking. His thinking is definitely a lesson for investors. Warren Buffett follows a disciplined approach. Currently, he is holding $324 billion in cash. So it's a huge sum waiting for the right opportunities. He focuses on fundamentally strong businesses with long-term growth potential rather than chasing market trends. Investors can learn from this by avoiding overvalued stocks, keeping cash ready for market conditions, and prioritizing companies with strong financials for sustainable returns. He said that he prefers good businesses over cash. Try to understand that, you will get what the great man is saying. He prefers good businesses over cash. So before ending, the market outlook remains mixed, with banking and financial benefit from strong earnings and lower bad loans, while infra and manufacturing and few others gain from increased government spending and economic expansion. On the other hand, IT stocks are facing challenges due to global slowdown and weak demand, while FMCG stocks struggle with rural demand pressure and shrinking market. Additionally, overvalued stocks remain risky as their prices are stretched behind earnings potential. So my final thoughts on what investors should do now. Investors should be selective, focusing on companies with strong financials and growth potential rather than chasing market trends. Keeping cash ready is crucial, as market dips often present great buying opportunities. At the same time, avoiding overpaying for stocks ensures better long-term returns. A patient, well-informed approach is key to navigating current market conditions successfully. All we can do is find great companies and keep on studying the company you find interesting. And if you have cash, deploy them at fair prices and hold them through the fall and the rise. So I hope I answered your question, whether to hold or to buy or to sell. Do not look at the outside noise, only look at the company you are focused on and understand their businesses and try to buy them at reasonable prices. So I hope this video was informative. Try to hit the like button and share the video with your friends. I will come back again with another interesting video. Until then, have a great time.